Hello, my fellow Ripplers. This is Chris Miles, your cash flow expert and anti-financial advisor. Hey, welcome to our show that's for you. Those that work so freaking hard for your money, and you're now ready for your money to start working harder for you right now. You want that freedom and cash flow today, not 30 or 40 years from now, but you want it right now. So you can live that life that you love, doing what you love. And most importantly, doing it with whom you love. But guys, this is not just about getting rich. It's about living a rich life, because as you are blessed financially, you have a greater capacity to create a ripple effect through the lives of others. And that is exactly what I'm here to do today. And thank you so much for allowing us to really create that ripple effect in your own lives, for tuning in. You've been binging, sharing. And guys, thank you so much. Shout out to our own clients as well. Those that are in the Money Ripples program, the VIP clients. Shout out to you guys. You guys have been ripping it up. Love seeing the fact that some of you guys are 20% on the way to your freedom goal. Some of you guys are already over 100% of your freedom goal. So thank you so much for you guys tuning in, even though you hear me all the time. Hey, as a reminder, guys, if you haven't done so already, go to our website, moneyripples.com, take the passive income calculator, find out how much passive income you could actually create in the next 12 months. Guys, it's pretty cool. You got to check that out right now.
Chris Miles was able to retire twice by the time he was 39 years old. But he's not content to just enjoy his own financial freedom and peace of mind. Chris wants you to have your own ripple effect so you can live free today. He's not the financial advisor you expected. He's the anti-financial advisor you deserve. He's jumping behind the mic right now, ready to make waves. Here's Chris Miles.
All right, guys. So I brought on a real special guest here today, that somebody that I've gotten to know in our mastermind circles, Tim Herriage here. Now, Tim, one thing you got to understand him, he's the executive director of RCN Capital. And he's also the host of the Uncontested Investing Show, which you should definitely check out. That's something I've actually been on as well. He's in a lot of different real estate businesses. This is why I'm bringing him on, because I want to really get his perspective on what's going on. I mean, everything from, he's been in the real estate investor space, obviously, for a couple of decades. But most importantly, guys, like he's also in REI circles, with real estate investors that way. He's also like co-founder or founder of the 2020 REI group. He's a co-founder and managing director of which now Finance of America. Also founder of the REI Expo, if you've ever been to that. So not to mention, he's been a franchisee and development agent for the Home Investors of America. So this guy has got his finger on the pulse, and that's exactly what we want, because I want to challenge whatever the media has been telling you, because that's probably why most people get stuck never being wealthy. And so that's why I brought Tim on here today. So Tim, thanks for joining our show today.
Hey, Chris, how are you?
Man, fantastic. Glad to have you on, man. So give us a little bit more on your background. I mean, obviously you've had a few decades of experience in the real estate space, kind of like I have as well, but go deeper. Tell us more of your story.
Yeah. Went to the Marine Corps straight out of high school. Got a job selling life insurance after that. Realized that wasn't any fun.
That's awesome. We actually talk about infinite banking on the show. That's great. I love it.
From there, I ended up, I got a job as a project manager for a house flipper here in Dallas. And that was really the beginning of the time in the industry. My parents built houses when I was a kid, but it started doing his project management, his owner finance sales. He taught me the acquisition part about a year into doing that. Then I went out, just like everybody, got enough information, wanted to go out on my own. Partnered up with a local hard money lender and started building a big owner finance note portfolio. A couple of years after that, my wife sold me a house. So I partnered with her, left the other partnership. Gosh, the year before the Great Recession, we did 143 flips. And, almost lost everything we ever had, 08 and 09. Made it through without any foreclosures and still married. Two things that a lot of people didn't do.
Yeah.
Started the REI Expo, sold out to Think Realty, met the guys at Blackstone, started B2R Finance, merged that with Finance of America, took it public in 21. And now I'm the executive director at RCN Capital. I've been borrowing from RCN for about 5 or 6 years now, maybe longer than that. CEO Jeff Tesh, founder CEO, is just a great friend of mine. And after we took FOA public, he called me and said, "Hey, dude, you want to do it again?" And I said, "Yeah, why not?"
That's awesome, man. You've kind of you've gone around. I mean, I'm saying this in the most least sleazy Mac Daddy way possible, right? But I mean, Man, I mean, you've definitely had a lot of experience in this space and what's been going on here. What are I want to kind of go back to, getting your teeth kicked in a little bit with the flips, because I think it's awesome that, I mean, you're able to come out of that unscathed. I didn't, right? Like I came out with over $1 million of debt and had to pay that back. Kept my marriage intact, at least to a certain point, but it was rough on the marriage too. I mean, tell us more about that. Like how are you able to pull through?
I've got a great wife, and she won't ever listen to this. I'm not just saying that to kiss up to her. We just shifted. We went to the Home Investors Convention that December, and they gave us all the book "Who Moved My Cheese," and I read it and I listened, and I've always been the kind of person I go around and ask advice and opinions from people. Mm-hmm. So I just started diving in, and it just I think the biggest thing is I took massive action quickly. A lot of people were ignoring the real impact that the issues were going to have on them, whereas I listened to the whys. And so we had 38 vacant houses in August of 2007 whenever the crash happened. Mm-hmm. That's the crash. Everybody remembers 2008, but August 2007 is when the subprime market imploded. And I called a good friend of mine that we were in another mastermind with. Masterminds have always been a big part of my life. And I said, Jeff, what does this mean? He goes, we're effed. And I was like, okay, but can you expand on that? He was like, we're effed. Sell everything you have. And I was like, okay, great. And I did it. I just started dropping the prices, taking losses, offloading inventory. Our rentals, that we had some really bad rentals that, when money's easy and everything's going up, you just kind of keep the houses that nobody else wants. Uh-huh. And then, when the market slows down, you realize you have a toxic rental portfolio. So, we started, I would go to work so my wife went and became an REO agent. She started selling Fannie Mae and Freddie Mac foreclosures in our hometown. And, that was pretty good money. Those are $300,000-$400,000 sales. So that was her full-time job. I was a stay-at-home dad for a certain part of that with our now he's 13-year-old. Mm-hmm. But I would go evict, do some of the work myself, and we sold a lot of houses on owner finance. So by doing that, we were able to create that income, but then also capture the down payment to offset the lack of capital that we were experiencing. So, how do we do it? Just got up every morning and went to work, and it was not fun, nor was it easy, but I'm glad we did it.
Yeah, I love that story because it really shows that you did a few things that I picked up here from what you just said. I mean, one is you didn't just trust on thinking, well, it's always worked, I'm just going to keep doing that. You sought counsel, right? You kind of had that mastermind or those people around you that you could talk to and be able to say what's going on in real time. But then on top of that, you were able to still maneuver, figure out what's going on. Like I remember REOs back then, and like they were hot. I mean, when you're selling for less than 10 cents on the dollar, right? I mean, as long as you didn't have a huge tax liens on it, and you're like, oh crap, I just bought a turd. But for the most part, I mean, it sounds like you guys really maneuvered that nicely.
Yeah. I've always been one of those, one of my mentors said, never sacrifice good enough for perfect. Mm-hmm. I think, so many people are always trying to achieve the perfect strategy, the perfect plan, the perfect outcome when good enough gets you by. And so, yeah, when my cheese was moved, and it helps to have a family you have to support. I mean, because I didn't have any choice. You got to do what you got to do, and it's probably the Marine in me, a little bit of a Type A personality too. And that's ultimately the message that I was spreading. Really, starting February of 22 was I told every new investor that would listen to me, like, hey, this is going to be bad. You don't know, And, it's funny. Some of them didn't listen and some of them did. And I kind of approached my business and my life with everything of, just do good and help people, and good and help will come your way. And it was interesting, though, to watch kind of the last call it 17 months has been very interesting to watch with the way the investors are receiving the information that is out there, and then ultimately what they're doing with that information. I think, I went to Mike Hambright's Investor Fuel in the first week of February, 2022. And I got up there during my sponsor spotlight and I said, guys, y'all got to listen to me. You don't understand the effects that this interest rate is going to have. Interest rate increases are going to have. We don't know how far they're going to go. Inflation's baked in. Told them, I said, if you've got inventory, now is the time to reposition it. Because back then we were still closing loans at 3.75% on 30-year fixed for DSCR investors, or the rental loans. So the investor mentality in February of last year was, this isn't going to hurt me. I'm fine. Mm-hmm. And then we got around to the May Investor Fuel meeting, and it was interesting. It was almost a sense of arrogance developing, right? Uh-huh. Because rates had gone up, but if you remember, there was a massive rush to buy houses.
That's right.
So they were all making money hand over fist. So at that point, they were like, well, shoot, that ain't going to work. This isn't a bad. What do you mean, Tim? I'm like, guys, you don't understand. This is this false insecurity. Well, by the time we showed up at the August meeting, it's like, I think I have to let my staff go. I'm going to need to stop advertising. Not sure I can pay for the mastermind. And then it was funny. In December, it was like, I may shut down the business because his November meeting, everybody had, cut half their staff. But then you roll around to this February's meeting, it was very interesting. Everybody has now, in the Marine Corps, we'd call it embrace the suck, right? They've adjusted. They've made the ones that are still there have adjusted. Mm-hmm. The ones that are still there, they reduce their staff, they reduce their overhead, they reduce their expenses, and now they're optimistic about buying back in at today's prices, because many of the markets have gone down 20%. So, I think we've reverted back to normal, and that sentiment is going to be a lot more keen on discipline, on maybe a slower scale, right? Not trying to hurry up. I feel like the investor mentality and discipline has gotten to, I said it on the stage at Family Mastermind, short and simple wins the day, right? At this point in the market cycle in real estate, you don't want a lot of exposure. You don't want a lot of short-term exposure, because that's the next 2 years is the weird part. Pretty sure we all know where we'll be in 10 years.
Yeah. And that's kind of what I was going to ask you next is, where do you see it going now? Like, do you see this, like you said, it's like more slower scale? Like how is it different? Like how would somebody pivot or do it differently today than they were trying to do in 2021 or 2022?
Well, the lagging effect of these policy changes is so difficult to measure in less than 6 to 12 months. Yeah, it just doesn't have enough time to get all the way through the economy. I can tell you this: as we sit here today, I filed my first eviction in 3 years. Wow. Yeah, I mean, I didn't. My manager did. As we sit here today, I have more delinquency in my rental portfolio than I have in 3 years. I think real estate investors are taking the market and they're using the average of 3 comps instead of the high comp, right? Like, I mean, it's just back to discipline. It's for a while there, it had gotten to where you didn't need 3 comps. Just pick the highest one, tack 10% on, and that's what it would sell for. Whereas now it's getting more, the average of the 3 comps, and you may want to skew towards the low one. Unless you're under 300,000. If you're under 300,000, the affordable housing is where it's at. I mean,
Yeah.
that is, if we're 7 million houses short, interest rates are not going down from here. They may go down a little, like homeowner paper may get down in the fives. Our investor paper, we can already do a 5%, but we have a prepayment penalty. That's why. I think, I think one economist said this is a reversion, not a correction. We were just in opposite world for 3 years. It was nonsensical. People coming to Dallas paying $100,000 above asking price, and there were 3 other offers that same dollar amount with cash. So I don't know. I feel like the worst is over for the housing market. I'm not sure about intellectually, Chris. I think there should be some sort of recession coming, but as we sit here today, we still have 1.6 job openings for every unemployed person. I mean, how, in the Great Recession, it was less than 1, right? So if we got rid of half the job openings right now, I mean, the only way that works is if the places are closing and shutting their doors. I mean, because you can't get enough people to, support what we have right now. So I don't know. I feel like we may have achieved the soft landing that the Fed wanted, but I don't think rates go back down in 23. I think they really need to hold around where they're at for 6 to 12 months. They need to shake out some of the entrenched inflation. I don't know about you. I've got a teenage son, and I took him and 2 of his buddies on a ski trip, and we swing in a McDonald's, and it was $51 for 4 value meals. And I just remember the lady said it over the speaker, and I was just like, what? I mean, it was strange. So I don't know. I feel like I feel like there's more to run. There's more. The rates are not going to go down, and I don't think they should. I think that this is going to be a slow, steady bleed of the ones that are good businesses and the ones that aren't.
Yeah. Yeah, I agree. I can definitely see that happening. It's, it's interesting. You mentioned job openings. Something that just popped in my head is, whenever you have something that's, overinflated, right, or over the top, typically there always has to be that reversion or that correction, right? It makes you wonder, well, gee, for it to come back into balance, what does have to happen? Either 1, do we have to just lose a lot of companies or lose a lot of jobs? And 2, maybe that's the whole Fed's point. They're like, that's what they're trying to get to, is saying, how do we get this unemployment rate to not, which we know is already kind of falsified anyways, 3.4%, in April. Come on. I mean, that's ridiculous, but, and that's after layoffs and everything too. But it does make you wonder, like, what has to come into balance? Because, you mentioned, like, in some of the things you were telling those guys 2022, and I know we're in similar mastermind groups. I remember in 2019, we were kind of beating the same drum, as we were saying in 2022. We were saying, hey, listen, there's already a correction happening. We're already seeing even the Feds are starting to lower the rates quietly, right? They're saying, oh, I think there's something coming. So we're preparing for a recession then. And then, of course, with COVID, there's this huge influx of money, creates a much bigger bubble than we already saw before in the 2010s. And now we're like, oh, crap, now this correction is going to be even worse, right? And so for people to not be prepared, it's like, how did you not see this coming at this point? Well, I just thought I could ride that wave a little bit longer. Well, that's why you got to be prepared. That's where you have to be a little bit, almost a little bit trigger happy at that point.
Exactly. Completely agree. Well, I mean, I think when it comes to determining your behavior, I think of it like the military. You never make a decision on one source of information, right? So we're entering a point in time where listeners need to consume the news, but not the drama. Yeah. I listen to Bloomberg radio every morning. And even though Michael Bloomberg ran for office, it's just not a political radio station. They talk about financial news, and that's all I need to hear. I don't really care what Trump or Biden have done or are doing. I know that we're just going to do the opposite of that in a year or two anyway. That's the cycle we're in. But what I care is when they're saying that, interest rates are going up, I need to learn how that impacts me. I need to look at how it's impacting foreign economies. I need to look at what opportunities I have coming up and where to put my money. I mean, I need to, and I need to hear that the 2-year treasuries are still, 40 basis points higher than the 10-year. And I need to hear about swaps, and I need to hear about spreads, because ultimately I live and breathe in an interest rate driven industry and business. And affordability is important. And that's why I do it. So, but I don't act off of Bloomberg. I go ask our chief financial officer, hey, what does that mean? What do you think? I attend the National Private Lenders Association meeting, and I ask what they're doing and how their business is. And, from those, all those sources, that's just where we get, that's where you make your decisions. You make your decisions from a point of being informed, not a point of being influenced.
Yeah. Often I've found that it's almost like what's between the lines of what's being said is where the real power is, right? It's like, well, it's like you mentioned, like what kind of data really matters. Do we see things like, do we see things such as like the credit card delinquencies or even auto loan delinquencies, and how's that affecting what's happening to the average consumer, right? Or even just today, I was reading where one of the Fed presidents came out and said, yep, I'm expecting it to be a tightening of credit, which that's a big deal when it comes to the economy, because the loosening of credit is why the economy still seems like it's very healthy. But if all of a sudden banks, because of what's been going on in the springtime and their potential for failures, and maybe even government regulations become more strict or require bigger reserves, that just means less to lend out. That tightens credit markets, that tightens money flow and supply, and boom, we got a massive recession potentially.
I've been worried about the auto loan market for years now. Yeah. But it's interesting. This is it's going to be interesting. There was an article recently. I think the average vehicle payment is now over $1,000. Something to that effect. Don't quote me on. That's definitely information you do not take action on.
It's up there.
Yeah.
No, I think you're pretty right, actually.
Yeah, so it's like, man, it's something's got to give, right? And that's ultimately where the real estate market is as well. Something has to give. It's either interest rates or price, or it's cohabitation. It's people just staying put. Another interesting stat that may make this cycle be different than all other cycles is, the 50-year average of interest rates on mortgages is about 7.5%. I think it's 7.75 if I remember correctly. Well, right now, 93% of active mortgages in America are 4% or lower. 70-something% are 3% or lower. So the math right now, Chris, if I want to move and don't want to spend more money, I have to buy a smaller house and pay the same payment that I'm paying in my bigger house right now. Right. And so it's creating this issue of nobody's selling. They don't want to sell. Only if they have to sell will they sell. And when you look at that, it's stripped supply out of the market. Right. Because there's now a significantly intrinsic value behind that interest rate. So it's going to be interesting. I don't have the answer. I know we don't have enough houses for the human beings we have. I know things are awful expensive. Even if you doubled the amount of foreclosures that we had this month, we would not be back to the historical norm. If
Isn't
you
that interesting?
double the amount of homes on the market right now, we would not be back to historical norms.
Yeah.
I mean, there's only 2.6 months worth of supply of houses available. Healthy as 6.
Right.
So it's what I say. I tell people, you got just keep your timeline short, invest in income producing assets that you don't need to, I'd say, you don't plan to sell in the next 2 years. And man, fixed rate debt has never been more popular, has it?
That's for sure. Yep.
So, yeah.
Tim, I appreciate this. This is great stuff here. I mean, other than I mentioned the podcast, they can follow you on the Uncontested Investing Show, right? Where else can they follow you?
Yeah, I'm all over social. Tim Herriage is not a common name. So I'm at Tim Herriage on all the social platforms. And RCN Capital is at RCN_capital on all the platforms. I try to do my best to put out content that I think is helpful and entertaining, and brag on my kids when they smoke a home run.
That's right. No, you were really valuable here today. I really appreciate your insights and everything. And that's what I love. I love the fact that it's not like you're buying into the drama, right? That's what I want to dispel on the show is get away from the drama. Let's get to what's actually happening in the reality so that we're ready, for, no matter where this person is that's listening right now, whether they've got cash, they're ready to deploy, there's one, the right moment, or they're just trying to build up the cash, or maybe they need to build more cash because they're in a world of hurt if they don't. This gives lots of great insight. So I really appreciate your time and your expertise here, Tim.
Well, thank you for having me. And I guess I'll see you pretty soon.
Absolutely. Yeah, looking forward to it. And everybody else, same for you as well. Again, you could be a hero of the word, but it's so much more powerful if you're a doer as well. Like Tim had mentioned earlier, it's not just about taking perfect action. It could be imperfect action, but moving in that right direction that allows you to be able to be at a place where you're able to prosper. You go from ordinary to extraordinary. Guys, make it a wonderful and prosperous week, and we'll see you later.